This week's number one. Gen Z's number one most searched term on Spotify is, get this, sad. As a result, Spotify created a playlist called Bummer Summer. No joke. I have a child that is Gen Z, and when I ground him, I force him to go outside and socialize. Welcome to Prof G Markets. Today, we're discussing ARM's IPO, Instacart's S1 filing, and Salesforce's earnings. Here with the news is Prof G media analyst Ed Elson. Ed, I have this new sensation. I am happy to see you.
No way.
Yeah,
it's great to hear. I've
you.
been so sad without you. Life's been meaningless and dull for all of August. I'm glad you're back.
I get it. I understand. I think everyone can empathize with that. Everyone can empathize with that.
Are you going to keep doing this whole take an entire month off of work thing?
Yeah, I've done it for a few years.
Yeah?
Yeah, I don't.
You don't get anxious that you're not working? I got the sense that you're a little bit angsty towards the end there.
Yeah. I get restless. I try to do some writing. I'm actually really good at doing nothing. It's like a core competence. But I like to at least have some deadlines and try and do some stuff. I think I did less this August than I have done, I don't know, since I was in college, where I was outstanding at doing nothing in college. Yeah, I'm glad to be back at work.
Any exotic experiences?
Not really. We're in Colorado, and then we were in Nantucket.
Mm-hmm.
Nothing that interesting. I was in Mykonos. So how was Mykonos for you?
It was epic.
Epic?
Yep.
What
7
does that
days of not drinking and not partying. Just hanging out.
What?
Had some fun.
Are you being sarcastic? So where did you...
That's a joke.
Where did you... What club... Like, what happened? What happened?
Let's see. We hit up all the spots. We went to Alamagoo. We went to Spiliar.
Mm-hmm.
It was all a blur. It was great. Yeah, we're deciding. Yeah.
Break down the news, Ed. Save me from myself here.
All right, let's start with our weekly review of market vitals. The S&P was down, the dollar rose, Bitcoin dropped, and the yield on 10-year treasuries climbed. Shifting to the headlines. China expanded a ban on government worker use of iPhones due to cybersecurity concerns. The country is one of Apple's largest markets, accounting for 19% of its revenue. Shares fell as much as 7%, wiping out more than $200 billion in market value. Warner Brothers Discovery slashed its full-year adjusted earnings guidance by $500 million. The company says that cut is owed to the writers' strike. Meanwhile, CNN is launching 24/7 live news on the Max streaming app. CNN Max will arrive just more than a year after CNN Plus was shut down. And finally, Lionel Messi's Inter Miami debut drove 110,000 new signups in one day to MLS Season Pass, which Apple has exclusive rights to distribute. Apple CEO Tim Cook credited Messi on the last earnings call for his contribution to Apple TV's subscriber growth. Scott, I actually saw Messi. I saw him play at the Red Bull Arena a couple of weeks ago. Do you have any thoughts on this?
I love this. I think it was, American soccer, the MLS, whatever they call it, is, everyone's waiting for tomorrow to be today. And a lot of people think the league will never reach the same heights as other leagues in Europe because we don't have a relegation system.
Mm-hmm.
Anyway, and it's kind of where people come to spend their last couple of years. But I just think it's wonderful. I think it's a win for him. It's a win for the MLS. It's a win for his family because they get to hang out in Miami. And just the power of celebrity and social media and the impact it has across so many different, celebrity just continues to be something that's very monetizable. And also it's an inspiration to watch him. So I'm nothing really there other than it's fascinating and fun.
Yeah.
Best news I haven't in a while. In terms of China, we're in a full-blown shooting match, trading war now with China, where Montana bans TikTok, and we're talking about banning TikTok. And this was an attempt to say, okay, the most valuable company in the world that's headquartered in the U.S. actually has more employees in China, and it's also the second largest consumer market for your phones, just beyond the U.S. So Apple's Achilles heel or soft tissue has always been China.
Mm.
And I think that Xi and Cook are probably on speed dial with each other. And Apple's been largely ring fenced or protected by Xi, I think, in the CCP because they see the company is just so integral to their growth. And I think they have a great relationship with them, their supply chain. I just got to think there's literally millions of people who are directly or indirectly get their living in China from Apple. But I think they've decided, look, that we need to send a signal that every time they punch us and, fuck with us, specifically ByteDance, we're going to fuck with them. I mean, there's few things that could lift more people out of poverty than China and the U.S. getting along. Because the cocaine and champagne of our incredible consumption culture, their emerging economy, their manufacturing and supply chain prowess with our innovation and intellectual property, creativity, we could kind of we could create just a ton of shareholder value, a ton of jobs that would absolutely lift both boats and lift all boats globally. And so war is expensive. And this is the type of war that isn't felt, it's felt 1,000 different ways where it's, the cost of something, the cost of, a certain sound insulation I'm looking at. I'm sure 80% of our sound insulation in this room came from China, and the costs are going to go up. And that means fewer people. I mean, the standard of living for everyone across the world is going to go down when we have trade wars like this. And so there's few things that would be a greater unlock economically than China and U.S. repairing the relationships. At the same time, I think China has definitely kind of outed itself. It's not our enemy, but they used to be our competitor, and now I would see them squarely as our adversary. And I think what will be really interesting is how they respond if we do, in fact, get close to a TikTok ban.
So I just on China, I don't know if you watch the Republican debates, but that was sort of a big topic, is that we need to just completely cut off any dependence on China. We need to recognize them as our enemy, and then we need to treat them that way politically and then also in the corporate world. And that's sort of what we're seeing develop with Apple and this Huawei ban and in the US and so on. Where do you stand in terms of politics? Do you agree? Should we be completely cutting China off?
No, we can't.
Okay.
We can't afford it. 80% of all toys sold in the U.S. are made in China. So there's few things you could do to raise taxes or decrease the quality of life for middle Americans more than just a total import and export ban. The North Face, this great company, started in Berkeley. It took them 40 years to get to $1 billion. It took them 2 years to get to $1 billion in sales in China. So this is a delicate issue, and we have to, through diplomacy, I think we have to stand firm and obviously protect our interests, especially around the chips. But I'm not a purist here. I would like to trade and develop stronger economic ties with the Kingdom of Saudi Arabia, because I think at the end of the day, we want to be the most economically prosperous nation in the world, and the way you do that is with free trade. I don't have any what I'd
But
call
from a trade policy perspective, are you down for making it sort of our MO that we wean ourselves off of our relations with China? I mean, I agreed we can't just cut it all off, but you mentioned you want to increase our relations with Kingdom of Saudi Arabia. Is that a trade-off that you're willing to make? Maybe at a higher expense?
What has always been interesting about trade, or the learning here that might surprise people, or it surprised me as my colleague at NYU, Pankaj Jemawat, who's an economist, did this great work on trade. And what he found was that your biggest trading partners are always the ones you share borders with. The proximity and distance matter. That Canada and Mexico will always be like numbers 1 and 2 because, in generally speaking, go to any nation, and it's the ones they border. They're more culturally familiar. The transportation costs are lower. If they have borders, usually they've figured out a way to kind of get along. Trade, I think diversification is hugely important, but there's just no getting around it. A trade war between China and the U.S. is a tax on every consumer globally. Let's move on to Warner Brothers Discovery. So this notion, and it's just hilarious, that it's the writer's strike is the reason why they've lost $500 million. This is David Zaslav. I mean, here's the real story. I'm David Zaslav. I wanted to live in Hollywood and have a Porsche and get invited to the Academy Awards. And I was willing to do a stupid deal and overpay and bail out AT&T, who did even a stupider deal and a more stupid deal and overpaid even more. And now I'm going to blame my melting ice cube of a shitty business, specifically cable television, where the ads continue to fall, or ad rates continue to fall, and advertising revenues continue to fall. I'm going to blame it on the writer strike. And I don't doubt that the writer strike hurt these guys. And what's interesting is that the notion that Netflix is on the same quote-unquote side of the table as Time Warner and Disney is just ridiculous, because I believe every day the writer strike goes on, it does hurt Time Warner, it does hurt Disney, because they can't go to the upfronts and sell advertising because they have no new programming. Whereas Netflix, who gets a great deal of program internationally, 10,000 people producing content in just Madrid alone, and a content queue that is just so dramatically deep. And I think Netflix loves this strike. And Netflix just announced about 2 weeks ago, that their cash hoard, their cash pile, has grown so fast because they have this kind of reduction in content production that they're going to do additional share buybacks, and the stock is up. So it's just hilarious that Time Warner and Disney are on this, at least initially, are pretending to be on the same side as Netflix. If I were Netflix, I would just come up with all these reasons, thoughtful reasons around why we shouldn't end the strike. Netflix comes out of this a big winner, Time Warner a big loser. But that $500 million loss is a function of, it's just, to be in ad-supported cable is just a shitty business. I think where the model is headed is, I read something super interesting. The guy who started 5 Hour Energy is now a multi-billionaire, is going and buying these regional sports networks and essentially firing everybody and using AI to produce minimum viable content at a fraction of the cost. I think you're going to see a lot of that. I think you're going to, here at Prof G, we're talking about using AI to expand into different languages at what would have been several $1,000s an episode to get an actor to read and try and exhibit the sort of good looks and charm of Scott and Ed, respectively. And then, but now with AI, our crack tech team here has come up with, found the right technology where we can do this for, much lower costs. And if it works, we're going to do it in Portuguese. And anyways, that to me is kind of the new model of media, ground up using technology to do stuff kind of that's not as good, but 90% as good for 2%, 10% of the price. So what I think is going to happen is that we're going to go good bank, bad bank. And that is, there's going to be consolidation. I think it'll start at Viacom. I think Sherry Redstone has to find a strategy here. And Paramount Plus actually does have a story. But what happens is, in all of these earnings calls at Time Warner, Disney, Viacom, is they talk about subscriber growth, and they can kind of explain, they can say, look, we're growing our streaming things. That's the future. It's really expensive. But I think the market will say, all right, we'll give you the benefit of the doubt. At least it's growing. And then they spend the rest of the earnings call apologizing for how the decline in business at their traditional cash cows, that is cable. I think what they're going to do is spin those assets into NewCo. There'll be consolidation. Someone will come in and buy up all of these assets, whether it's the Cartoon Network or the Learning Channel or the Food Network, just all of these things, and cut costs and stop this consensual hallucination that these things are ever going to grow again, and try and cut costs faster than the decline in revenues. Because the thing about these businesses, they usually go out of business more slowly than you think. So I think there's going to be a good bank, bad bank. I think these guys are going to, Disney, Iger has basically said FX and ABC, he's put them in the front of the lawn and said, best offer, no reasonable offer refused. And then they will have a cleaner story. Because I think if you just say, look, I'm Disney and I got Parks and Disney Plus, but I don't own ABC and FX, I think it's just a cleaner story. Because what happens in these headed hydras with different companies with different business models is that people or investors hate conglomerates. And they'll look at these things and they'll find the shittiest business, which is the ad-supported cable businesses, and they'll assign that multiple of that value to the entire thing. When Peacock or Paramount Plus or HBO should trade at much higher multiples. When I was on the board of the New York Times, we had some really great assets. We owned 17% of the Boston Red Sox. If that doesn't make any sense, trust your judgment. We owned the seventh tallest building in America, our headquarters, which made no sense either. And we owned About.com, which at the time was growing. But it made no sense to own all of these things. They had no synergy whatsoever. And so the market would say, what's the shittiest asset? Well, it's newspapers, and let's assign that multiple to the entire business. I believe that Paramount, Time Warner, Disney could probably shed these cable assets or sell them for $1. And within a year, their stocks would be higher than they are now, even without those cash flows, or if they could strike a good deal to get, monetize or securitize those cash flows in the sale, because their story would just be cleaner. So I think you're going to see consolidation and sort of a good bank, bad bank happen across all of ad-supported media. I think the CNN launching a 24/7 live news on the Mac streaming app is actually the beginning of a very innovative idea. And that is, if I were CNN, I would become like Intel Inside. And that I would say, okay, I have a newsroom. I have the best newsroom in the world. And if Netflix or Apple TV or Amazon, if you pay us X dollars, in exchange for that, you can put a little CNN logo on your app or on your service or on your platform, and at any point, someone can just click on it and click business, politics, culture, and get a 10, 15, 20-minute loop that's updated, twice a day during a normal day, 12 times a day during the insurrection. Because the thing that kills these things is the cost of having 16 hours a day of programming. And what they really should do is, people don't want all that programming. CNN should say, we're going to bring you the best news in the world because we have the best newsroom in the world. But for $2, $5, $100, $300 million a year, Apple TV Plus, you can have access to just plug and play news. So, and I think this is a start. I think having the ability to be on, HBO Max and just click a button and have over-the-top, tighter, commercial-free news, I think that makes a lot of sense. I think it's smart, and I think that's, if you will, how CNN creates a lot of value. So I'm a fan of that.
That might have been our longest headlines in history. You're back.
Yeah,
We
no,
love
it's,
it.
you know what? You asked me what I did in August. I did edibles. I'm not as crisp. I'm definitely
We love
a
it.
little
That was
slow.
great.
We got to get
Let's-
gotta let the engine heat up. You don't remember this because you're
You're
14,
wrapping up.
but my dad literally, when we would go somewhere and it was cold, he'd say, "Oh, go start the car and get the engine heated up." And he would go into the garage,
Just
turn on the
Scottish
car, and let it run for 10 minutes before we could actually drive. That was the technology that I had to deal. I had a Plymouth Fury 3. That bitch was so sexy. Got like literally 4 miles to the gallon or 4 gallons to the mile. And roll up windows, like no power steering. You like get a workout trying to just turn the thing, and oh my god, it had a V8. Hello, ladies. That was a muscle car.
We're going to work on your Scottish accent as well.
There you go.
Let's move on to our first story. The biggest IPO of the past 2 years is just around the corner. Last week, British chipmaker Arm, spelled ARM, kicked off its roadshow and revealed it will go public at a target valuation of $52 billion. For context, other companies of that size include Chipotle, Lululemon, and Dell. Arm specializes in smartphone processor designs. Its clients include Apple, Google, Nvidia, and Samsung, and each of those companies have agreed to buy shares at the IPO. Its largest shareholder, though, is Softbank, a Japanese investment firm run by Masayoshi Son. We'll get to Softbank's involvement in this deal in a moment, but Scott, first, you predicted that the IPO market would pick back up in the second half of this year. It looks like you were right. We've seen a slight pickup in IPOs recently. We had 15 in July and 11 in August. Do you have any initial thoughts on Arm as a company or on this IPO and what it might do to the IPO market?
So, I mean, there's two things here. The first thing is indisputable. It's a great business. They power, I think, their chips power 99% of the world's smartphones. 70% of the world's population uses an ARM-based product. Their chips aren't just in smartphones, they're in other things: smart speakers, TVs, surveillance cameras, thermostats. The average U.S. household, get this, Ed, has 22 connected devices in 2022, and that's up from 11 devices in 2019. Quick math, that means it's doubled in about 4 years. And ARM just dominates the smartphone CPU market. And they also see growth in cloud computing. They do licensing agreement, receive royalty payments for chips, which have incredible margins. Licensing is 37% of the revenue. Royalty is 63% of the revenue. Their growth was flat last year, which will hurt the valuation because of a slump in smartphone shipments, and net income declined. And it's a weird time to go public in the sense that they posted a 20% net income margin on $2.7 billion in revenue in 2023. That was down from 27% net income margins in 2021. Chip designs have incredible. It's a typical technology company that's very IP driven, and that is they're incredibly expensive to develop, and then they have monstrous margins, right? Software to launch a software product costs millions, if not hundreds of millions, to develop, but then you have 90 plus points of gross margin. Their research costs were 42% of revenue last year, but their gross profit margin was 96%, and their operating income margin was 25%. About a quarter of the revenue comes from China, and again, we talked about the risk there. And this also comes down to valuation, and that is there has never been a drunken sailor like Softbank. And in terms of just throwing cash at the wall with crazy valuations. And they're supposedly targeting an IPO price range of 47 to about 51 bucks a share, which would give it 18 times its trailing 12-month revenue. And NVIDIA trades at 37, but I would argue NVIDIA's radically overvalued. So what will be interesting is if SoftBank gets their money back or makes money, because at some point it was a bad investment. And so what will be interesting is on the first trade if SoftBank actually is in the red or the black here.
Yeah, so we'll get to SoftBank in a moment. But you mentioned the valuation. Arm has 18 times price to trailing 12-month sales multiple. And then you mentioned NVIDIA, which is at 37. But then you compare to other chip makers, Intel's at 3x, Qualcomm's at 3x, AMD's at 8x. So ARM's on the higher end here. And I agree, NVIDIA is probably way overvalued right now, riding off of this AI boom. But ARM's still high. Do you think that a $50 billion valuation is too ambitious compared to those other chip makers, which are seeing like 3 and 7 and 8x multiples?
I do, because, I mean, what's the story? It's not growing. Maybe it'll start growing again. I guess the dominance in the smartphone market. I don't know what maybe the moats here, but it's hard to see. Again, at the valuation that banks are talking about, they're going to SoftBank is going to have to take, I think, like a 30% haircut, and that is the expected valuation on the day of the IPO is below what SoftBank paid for it. But SoftBank needs to get some cash back. It wants to take the product out. I would bet the banker said, look, there's demand for kind of blue chip, big, iconic brands like this. And at some point, alternative investment companies, they're not meant to be holders. They once they get to 3, 5, 7 years, they want out.
Before, because I didn't mention SoftBank's role in this in the intro, so I should just clarify that. The context here is that SoftBank, which is the Japanese investment firm we've talked about a lot on this show, largely because of how poorly they perform, they own around 90% of the company. And last month, they valued the company at $64 billion, which is around 30% higher than the expected valuation at the IPO. So I just wanted to provide that context. But yeah, you were talking about that mismatch in valuation, the fact that they're going to go enter the public markets 30% lower. What are your thoughts on that?
Well, it sucks to be a grown-up. They got to get money back to their investors. They have to fund stuff. They're not meant to be, they're in the moving business, not in the storage business. And that is they need to move shares at some point out and recognize valuation for them. And the market has just changed dramatically. In addition, there have been, I would argue Masayoshi Son is the worst investor in history. He got incredibly lucky on his stake in Alibaba. And let's be honest, that was luck. And then everyone assumed, he must be a genius. And he began to prove that he's a terrible investor over and over and over again. And that the people who invested in SoftBank, it's just, show me a company that just makes no fucking sense, but raised money at $1 billion valuation, and there's a 1 in 2 chance it was funded by SoftBank. It just, this craziness infected all aspects of the organization. So I doubt they'll get their money back. It feels like, at least not for a while, a great company, an outstanding company. Tesla's an outstanding company. NVIDIA's an outstanding company, and they're dramatically overvalued, as is or was this firm when Softbank invested.
So, just the history of SoftBank's involvement in Arm. They acquired Arm back in 2016. They acquired it for $32 billion. And then they immediately sold 25% of that stake to their own Vision Fund, which is SoftBank's tech-focused venture fund, basically. And just a side note, when they made that trade, Master Son told analysts, you can say, quote, you can say almost with confidence that it will grow 5x in 5 years. That obviously didn't happen. But something strange is that last month, SoftBank bought back that stake from its own Vision Fund unit. And that's where we saw this $64 billion valuation. My question to you, have you seen that before? Why would SoftBank be transferring its stake in a company between different units and essentially buying it back from the Vision Fund? What's the point in that?
There might be something administrative here around tax treatment or a change in strategy, and one asset makes more sense than the other. What it also might be is a purposeful head fake to the markets. And that is, they want to send a signal that smart people value this company at $64 billion. The last two rounds of WeWork were nothing, in my opinion, but jazz hands to say, oh no, this company is worth 35 or 40 billion because smart people are investing capital at this valuation, and you dumb shit retail investor should value it at 55 because here's the momentum. So it's a bit of a head fake. And I think that's probably what happened here is it wants to send a signal to the market. It wants to send a mark. In addition, they might be out raising money. And when you're raising money, the potential investors want to look at your returns, and your returns are based on marks. And you get to mark your assets at the most recent valuation. So isn't it fun? I'm on the board right now of a company, and we just closed a round. And I said, this is ridiculous that we're trying to raise at this valuation. Let's raise at a more sane valuation, even if it's a down round, and go raise more money because the company needs capital, and I think things are going to get worse. And what was clear is that the previous investor, who was the largest shareholder, would rather raise less money and would rather participate himself at a higher valuation so he can mark his book and his stake at a higher valuation, even if that valuation doesn't make any fucking sense. So he can then try and fly to Riyadh and say, I'm up 22%, not 11%, and you should invest more money. So you really have to look. These related party transactions are fake marks. Yep. The only marks you can trust are marks where a round is led by fresh capital that is new capital into the company. And they can get it wrong, but at least they think that is what the company is worth and that they're going to get a return on that investment.
This is exactly the question I wanted to ask, which is like, is Vision Fund going to now go to their LPs and say, oh, look at our rate of return. We made good money on our investments, when in reality, they just bought it. They sold it to themselves, which is completely fake. Should there be regulation around that, or does it not matter because at the end of the day, the investors are going to get their money back? I mean, the Kingdom of Saudi Arabia, who invested all of this money in the Vision Fund, yeah, they are going to get something back because they did sell that stake at a 64 billion valuation, however irrational that may be.
Yeah, I would imagine the Vision Fund is going to have a slightly more difficult time raising money than Bernie Madoff at this point. I just don't. I think an easy way to get fired would be to explain why you put capital into the Vision Fund in 2023.
Yep.
And I think what they've said is, let's take a horrible situation and try and make it just awful. Sell this thing, give us our money, good riddance, and we're gonna invest elsewhere. I can't imagine, but I've seen stranger things. People continue to invest in ARK, Kathy Wood's fund, despite every piece of evidence that they are terrible investors or not very good investors. So stranger things have happened, but what I found when I have had any sort of interaction, their primary investors are out of the Gulf. And something I admire and respect about the sovereign wealth funds and the investors in the Gulf is that they hire the best people, regardless of where they're from. And I mean, they're smart. I've actually been in
I
some of these
mean, but
meetings.
they're also SoftBank's biggest backers, right?
100%. But what I would say is that a decent definition of smart is that you learn.
Okay.
And you're going to make, it doesn't matter how smart you are, you're going to make mistakes. They fucked up. They trusted Masayoshi Son. They bought into this crazy vision. And you can see how it would happen. He took whatever it was, $50 million and turned it into $20 billion at Alibaba.
Hmm.
And, he's likable and charismatic. Although when I read his investment deck, it felt like a 16-year-old on shrooms before a business plan competition. It was just so weird. It'd have a picture of a hummingbird and then it would say, and then a microchip and it would say love. Like, what? Anyway, good for him. But they're not going to. I'd be shocked when I've been in meetings with these sovereigns or these funds in the Gulf. They have the best and brightest people poring over your numbers and asking really thoughtful, good questions. So I think SoftBank at this point is just about trying to get people, their pennies, their dimes, their hopefully 25 cents on the dollar back. This was you want to talk about giving someone $100 billion to go play in traffic. This thing just made absolutely no sense.
So there's another company that's about to IPO, and that's Instacart. They just filed their S1, and they're in a similar situation. So in 2021, they raised $265 million at a $39 billion valuation. But last year, they ran into some trouble, and they slashed that valuation first down to $24 billion and then to $10 billion. Now, they haven't disclosed any price targets for this IPO, but this firm, Meritech Capital, did a nice analysis, and they found that at a roughly 20x multiple on EBITDA, and that's around where most of these grocery delivery stocks trade at, the enterprise value would be $15 billion. Point being, it's likely going to be another massive reduction from the $39 billion valuation they received in 2021. Do you have any thoughts on Instacart's valuation journey?
We're going to see a lot of this. Again, this is a great company. A pandemic darling. They execute well. There's no reason, in my opinion, unless you enjoy it, for anyone to go into a grocery store. I think other than gas stations, grocery stores may be the worst retail. Maybe if you, with the exception of doctors' offices, if you consider that retail. And they have innovated and they save people time. We've always said that the fastest way to build a unicorn is to build a time machine. This is a time machine. It saves people time.
Mm-hmm.
It's not worth $39 billion. It got out in front of its skis. What's interesting here, and I've been in this situation several times, is what happens and the unnatural acts that are spawned by down rounds. So an example, when you invest in a company and you're the last money in, you're paying a higher valuation. All right, I'm in the C round. The A round was done at a valuation of 10 million, the B round 50 million, the C round 150 million. And that's bad. You're paying more, right? But the good news is you get something called a liquidity preference, meaning that if you invest 10 million bucks, or let's call it 25 million bucks in the C round at a valuation of 150 million, and then things don't go as well and the company gets sold for 30 million to another private company, the last investors get their full 25 million back before anyone else gets anything, and it waterfalls back until all the prefs have been met. And then the common shareholders start to participate pari passu with everybody else. So that is a wonderful thing to have. Now what happens is if a company's going public, and this happened to me at Red Envelope, at a lower valuation than what investors invested in the last round, they're kind of pissed off and they're thinking, well, actually, we'd rather you sell it to somebody else and then we'll get 100 cents on the dollar instead of 70 cents on the dollar. But the previous investors wanted to go public. And so there's some arm wrestling and some wrangling and sometimes some dealing. But generally speaking, what I say to entrepreneurs is be careful about raising money at a really big valuation because, granted, most investors, I'm looking at an investment right now, and we're arguing over valuation. I'm like, all right, you have to prove to me or show me how I'm going to get 5x on this if it goes well. So, okay, be careful what you ask for. If you raise money at $150 million valuation, keep in mind those investors are expecting you to have a liquidity event in 3 to 7 years at $750 million. And if you don't...
What stage is this company that you're looking at?
It's a growth stage company. So it's a company that's doing it's a small VC-backed company in a business very similar to L2, so I understand it.
Okay.
The company's killing it. The founder's great. It just feels, smells, and looks like L2. And I'm like, okay, you want to raise money at a $30 million valuation. How does this get worth $150 million with dilution of employees? How's it going to be worth $200 million? Because if it's not, your last round of investors, unless this goes south, are going to tell you to just stick with it and aren't going to be open to conversations around an IPO or an acquisition until you get there. And I imagine there's a lot of that here, because what happens when you go public is all of those liquidity preferences disappear and every share becomes the same.
Mm-hmm.
So anyone who's underwater or invested at a large valuation would rather them keep going and not do the IPO unless they're fatigued and they just want to get their money out and they want some liquidity, and the company will be worth more and have the currency and the capital to grow the business. And the early investors are dying for everyone to convert to one class of stock, because then all those liquidity preferences ahead of them dissolve and go away. So there ends up being a lot of arguments and very pointed conversations and intransigence in the boardroom. When we were going public at Red Envelope, the last investor had invested at a higher valuation than the IPO, and they wouldn't approve the IPO until finally it became clear, like, we have no other options. And keep in mind, it's lower than you'd like, but it's going to end up being zero if we don't raise capital at some point.
Mm-hmm.
And the capital markets are friendly, so you're going to get, would you rather get 70 or 80 cents on the dollar or 30 in 2 years if we don't maintain momentum, have the currency for acquisitions and the capital to fund the business? So this is going to be a really interesting one, because while they're trying to position as technology, it sort of is, but where I think they get most of their money is from advertising on the platform. And what's interesting is that the margins that drive grocery and even Amazon are not the sale of groceries. It's the equivalent of shopper marketing. So what do we mean by that? You buy diapers, there's like no margin on it. The store doesn't make much money, but what they make money on is Pampers will set up a cardboard cutout end cap, and they pay the store to try and gain market share. Picture of a cute baby, a cutout of Tom Brady and a Bud Light end cap. Shopper marketing or in-store marketing is actually a bigger business than brand-based marketing or advertising, which was shocking to me. And Amazon makes just a shit ton of money going to Pepsi and saying, when someone types in or searches for Coca-Cola on the Amazon platform, would you like a Pepsi ad to come up? It's just an amazing business. And my understanding is the same is true of Instacart, that they make a lot of money with advertising. And just some stats on them. They have grown 8 straight quarters, their revenue. They're GAAP profitable for the last 5 quarters. So this is a good business. Online grocery, the category is growing. It represented 12% of the grocery market, and that's up from 3%. We were really slow in the U.S. to get there, and it was obvious it was going to happen at some point. They've got about a 2.6% share of the overall U.S. grocery market and 22% online. And they've got good growth in margins. Revenues increased 39% in 2022 to $2.6 billion, and they're producing more than $100 million a quarter in operating cash flow. And that's more than $1 million per day. Makes sense. Really sophisticated math from our producers there. As revenues increased, costs have decreased proportionally. Administrative expenses declined from 19% in 2020 to 13%. So scale and growth are a wonderful thing, can spread those fixed costs across a broader base. And operations expenses declined from 22% to 10%. And their gross margins exceed that of Amazon and Walmart at 75% versus 48 and 24 at Amazon and Walmart, respectively. But again, a great business, growing. It just got out over its skis, as a lot of companies did in terms of valuation. It looks like it's going to go out at $15 billion. So what is that? That's a haircut of 50 or 60 at, at some point they had a $40 billion valuation. That's a 60 point haircut. And the analogy I would use is that grocery stores are sort of the cable companies of the 90s. And that is, they don't make money selling content. They make money advertising against it. So think of the groceries, think of the produce, think of the meat, think of the cereal as content. And then they run commercials against that content. 72% of Instacart's revenue came from transactions and 28% from advertising. But that's probably misleading, because I would bet the margins on that 28% are
Massive.
90%, and the margins
it's they've shifted that revenue, so that's been growing. I'm not sure what the original number was, but they've been focusing a lot more on advertising because of those the difference in margins.
And just look at an analog here. Amazon's advertising sales are growing faster than AWS revenue. The Amazon Media Group, which sell ads on the platform, brought in $11 billion in Q2. Let me think about that. $11 billion in one quarter, up 22%, while AWS revenue increased 12%. And the margins on those revenues must be enormous.
Yeah.
Analysts estimate that Amazon Media Group's operating margins, not their gross margins, their operating margins after they're done paying everybody, are well over 50%. I mean, and Amazon commands 7.3% of the worldwide digital ad market. Alphabet's at 29 and Meta's at 21. I mean, who would have thought that Amazon, I think that makes Amazon one of the 10 biggest media companies in the world. Mm-hmm. So Instacart is not in the business of grocery. It's in the business of selling you groceries such that it can sell ads against that content of produce and meat.
Yeah, no, I think that's a great comparison. I mean, my brother-in-law ran a drinks business for a while. It was a hard seltzer company. And, he was competing with White Claw and everything was going well until Bud decided that they wanted to start selling Bud hard seltzer. And he said that was the big turning point, because what they would do is they would stack the entire shelf space, not because they thought they were going to sell the seltzer and sell the cans, but just they wanted to take up all of that space and basically turn it into a giant billboard. And, he called it boxing out. And it feels like what we're seeing here is just advertising, like you're talking about shopper marketing. It's going in a different direction where suddenly there's personalization. You can look at impressions, you can look at clicks, click-through rates, you can look at average spend per customer. And yeah, absolutely, that's what Instacart's taking advantage of here. Let's move on to our next story. For the past year, Salesforce has been through the ringer. In December, the co-CEO Brett Taylor resigned. The next month, they laid off 10% of the staff, and just weeks later, they were targeted by activist investment firm Elliott Management. Elliott's demands were simple: focus on profits and cut costs dramatically. Well, it appears Salesforce has listened. The company's Q2 earnings report showed that quarterly net income rose from $68 million to $1.3 billion. That's a near 20-fold increase. Salesforce also reported a 31.6% operating margin and raised its annual margin guidance to 30%. CEO Mark Benioff had aimed to hit this milestone in 2025 and said that reaching it this year was, quote, nothing short of a miracle. Salesforce shares jumped 6% on the news. Scott, reactions to that?
Here's the thing. Cost cutting is a lot of fun from a shareholder standpoint if there's costs to be cut. And when you stuff so many calories down the esophagus of a growth company that it develops fat everywhere, you can do one of two things to add the same amount of earnings. Say the operating margins are 20 points, which is very healthy operating margins. You can either grow your top line by $5 billion or cut costs $1 billion. Same effect to your earnings. So when you actually come to the conclusion that we're a little bit overweight, maybe even obese here, and we're going to go on a diet, and it's not fun, and there's so much pattern recognition and expectation that we're going to keep investing, keep hiring, keep spending, keep growing, the cost cutting can be just incredibly powerful, especially if it doesn't have an impact on frontline sales. So as we predicted last year, and we're sticking to this prediction, I think in Q4 of this year, you're going to see record earnings across big tech because they've discovered the great taste of cost cutting without the calories of losing revenue growth, because there appeared to be just thousands, if not tens of thousands of people doing almost no fucking work. And so this is, this is kind of the perfect activist play. And Salesforce is really sort of embodies the best of this year of efficiency. And it also is sort of a testament to the power and the importance that activists play in the ecosystem. Elliott came in. Elliott needs a company where they can put billions of dollars to work because they've raised a shit ton of money because of their success. And they look at Salesforce and like, great company, great leadership. You just spent too much money. You're just fat and you're drunk and you got to tighten the ship. And to a certain extent, I don't want to say it's a favor to Benioff, but it creates cloud cover for him to make really difficult decisions.
Yeah.
And what they found is these difficult decisions were difficult from a personal standpoint, difficult from a cultural standpoint that's never known anything but growth and investment. Mm-hmm. But oh my gosh, was this a spring waiting to be sprung, and that is that it does not appear to have affected their growth. So if you can maintain growth and cut costs at the same time, oh my God, champagne and cocaine for earnings, as evidenced by the fact that earnings went up 20-fold. So, and this is perfect for Elliott. Elliott doesn't have to fire the CEO. They don't have to stick around a long time. They just go in and say, you obviously have room to cut costs. Mark says, I get it. He does it. Elliott makes a shit ton of money. The stock recovers. And Benioff is seen as the CEO who's kind of taken him through the haunted forest here and come out the other end fine. So I think this is where you say the market is a wonderful thing and capitalism works. But this is an activist play that appears to be working out for all parties. And while everyone's focused on Meta's cost cutting, I think the real example of kind of where it worked out for everybody, obviously, except for the people who got laid off, but my guess is they're going to be just fine in an economy that has historically low unemployment.
Mm-hmm.
This just felt like win-win-win across the board.
You had a pretty good example of their exuberant spending yesterday, specifically Pivot's deal with Salesforce. Could you explain that?
Salesforce launched something called Salesforce Plus, which was a streaming network for Salesforce, and they paid us a lot of money for clips from Pivot, which
Can you disclose how much?
I cannot.
Okay.
And we're not doing it again this year. My guess is that was like a fairly quick decision, and I'd like to think they got return on it. But a streaming network from a CRM company is probably indicative of a company that might be overinvesting. Mm-hmm. And you need to make these types of bets, but I think they decided, I don't know the status of Salesforce Plus, but I don't hear very many people talking about it. So my guess is they probably cut it and cut costs sooner than they would have otherwise under the auspices of the pressure of an activist. And while, we love that revenue, you understand what's going on. They were doing a lot of experimentation. I mean, Google's been through this. Google startup, Ruth Porat, the CFO, came in from Morgan Stanley. The first thing she did was she just went down the list and said, these things make no fucking sense. Stop trying to cure death. Stop with the flying cars. We're just going to focus on this thing called search and YouTube and the shit that makes a lot of money or has a discernible path to making a lot of money. Mm-hmm. And, she was literally able, she didn't find change in the couch cushions. She found tens of billions of dollars just sitting there waiting and cost waiting to be cut. So, yeah, I think a lot of people in the ecosystem, including us at Pivot, felt some of those cost cuts. But I'm sure that another fantastic company will come in and buy our ads, Ed.
So you mentioned this idea of cutting costs without having to sacrifice anything on the top line, on your revenue, which is true of some companies. It's currently true of Salesforce. We are seeing revenue growth, but we'll see if that lasts over the next few quarters. But if you look at the entire SaaS ecosystem, it's sort of a different story. So they're all pursuing the same strategy, which is cut costs, focus on profitability. 3 years ago, SaaS companies were averaging around 5% in free cash flow margins. That number is up to 13%. But it does appear that it has come at a sacrifice to revenue growth. So in 2020, in that same period, average revenue growth across SaaS firms was 22%. That number is now down to 15%. So is there an argument to be made here that maybe these software and SaaS companies are overcorrecting, that they're playing too defensive in terms of pursuing profitability, and maybe they should be taking risks and investing in new technologies and finding new growth opportunities so that they can expand revenue in the top line? What are your thoughts on that?
Well, so the question comes down to this. Is that decline in revenue growth a function of a lack of investment or the fact that the economy's just slowed down, things have gotten more competitive, and the kind of crazy big gulp grande vente ayahuasca trip that every small company was on with cheap capital, that is always a big part of a customer base for a SaaS company. There just aren't as many of them signing up more and more people for the Salesforce platform or what have you, or the Snowflake or, name it. And so the SaaS market, which grew exponentially, that growth is slowing down regardless of how much money they threw at it. I would argue that the incremental or the cuts in expenditure did not have, at least in the SaaS market, is not the culprit. The culprit is the larger economy and the macro environment. And had they continued to make those investments, their growth wouldn't have been much greater. It's just their bottom line would have been much, much smaller. So my gut and the data I've seen is that these cost cuts were prudent and have had actually very little impact on what the top line growth would have been otherwise.
All right, thank you, Scott. Let's take a look at the week ahead. We'll see inflation data from the Consumer Price Index and the Producer Price Index. And separately, another strike is brewing. 150,000 members of the United Auto Workers are set to walk out later this week if a new contract agreement cannot be reached with Detroit automakers. That includes Stellantis, General Motors, and Ford. Do you have any predictions this week, Scott?
Yeah, I'm sort of into this idea of consolidation and good bank, bad bank across cable TV assets. And that is, if you look at Viacom, if you look at Time Warner, if you look at Disney, they all have good businesses and growing businesses. Their streaming platforms are too expensive, but there's a good story there. Like Paramount Plus is it's actually kind of an interesting streaming network that's growing. Disney Plus is losing too much money, but will have, is a very solid value proposition. HBO is, an incredible story. What junks this shit up is the analyst or the CFO on these analyst calls or these earnings calls has to spend the majority of the call apologizing for these shrinking ice cubes known as their ad-supported cable networks. And I think it muddies the story. One is a growth story that requires investment and should garner greater valuations. The other are distressed assets that are declining that are profitable. I think what you're going to see is a few players, maybe even several players, either sell or pledge their cable assets to kind of a bad bank. They will have a different operating mentality. They'll run for efficiencies. The model I use is when I was involved on the board of a Yellow Pages company. We would buy these things for 2 to 3 times EBITDA, cut costs faster than revenue declines, and it ended up being a very good business. So there needs to be recognition that cable TV assets are no longer teenagers that are going to keep growing, that they're in fact, Nana and Pop and need to be made comfortable, but these things are dying and they need to be managed for cash flow, not starved of investment, but stop the hallucination that these things are ever going to reignite growth again. So my prediction is you're going to see one or more players shed their assets into a different holdco to clean up their story and also for consolidation and scale. There needs to be a bunch of these things wrapped together so there's one sales rep in Czechoslovakia selling ads on the Cartoon Network or what have you. And it just needs to be a cleaner story and unfuck the story that is media companies now that have growth but also have declining assets in the same portfolio.
I know you've had conversations with a bunch of big players in media recently. Do you have any inside scoop from those executives?
I think everyone's landing at the same place that they have to do something. That whether it's the strike, whether it's the war between Charter and Disney right now, the model is just broken, and there needs to be consolidation. And the place that'll probably start will be Viacom. Sherry Redstone has seen her stock, I think it's lost 3/4 of its value in the last 5 years. She's got to do something. And that's where it'll probably start. But I think all of them are going to start shedding their cable assets or donating them or selling them to a new co. But I think a bunch of players, these assets are now getting cheap enough where they become distressed assets where private equity will probably start getting their pencils out and looking at them. And I think that's going to happen in the next 12 to 24 months. Thank you for watching this version of Prof G Markets. Check out our pod feed for office hours on Wednesday, and we'll be back with a fresh take on markets every Monday.